So if you think about policy in India, fiscal has been tight and it is tightening also going into next year. You're going to have a 40 basis points consolidation on fiscal policy. So it's really monetary policy which can ease given the cyclical slowdown that India is facing. Now, monetary policy tightened through three broad factors. One was the rates tightening, two was liquidity, three was macroprudential norms from the RBI, particularly on consumer loans. You've seen the RBI make the first moves on liquidity. They came out with a comprehensive set of measures to ease liquidity in the system. There's more that needs to be done. We think that was the prelude to rates easing, which in our view will start off today. We are in line with consensus on that, 25 basis points today, and then follow that up with one more in April. So it sort of brings short-term rates down and hopefully feeds into the real economy with a lag of around 6 months or so.
2 rate cuts and done?
There's a risk that you end up doing a bit more. I think the question really will be how the Fed behaves going into the second half of the year. Our expectation still is of the Fed going twice in the second half. If they do, and given the fact that the fiscal is consolidating, you could end up having a deeper easing cycle from India. But look, I mean, in India, nothing tightens financial conditions more than liquidity tightening, because that really drives up short-term rates, and corporates who borrow in the money market really face very steep rates at that point. So in our mind, the first thing to move would have been liquidity. The RBI has already done that. There's much more that needs to be done given the FX sales. But if they ease liquidity and then follow it up with rate cuts, we should be in a good position.
Yeah, but that's the whole point. Like, if you address the liquidity problem, then how much does this rate cut really help? Because from a transmission standpoint, I don't know whether it filters through with banks actually changing their base rates, given what they're seeing on deposit mobilization, money moving out of deposits into the stock markets, debt markets, investable assets. And so I wonder whether this is really required, whether it really is just a signaling tool more than anything else at this point, because the market is so hoping for a rate cut, because the market believes that the rate cut could, in some way or the other, help with the inflation picture.
Well, there are two things. One, on the deposit side, our point has been that the reserve money growth in India has been very low. So the RBI hasn't really expanded balance sheet for some time now. In fact, with the FX sales that are going on, it is actually the balance sheet size is declining. So you need to offset that with an OMO operation. That is the way of, again, building back balance sheets. And they have started on that. The quantum, can be questioned, 600 billion INR worth, whether that is enough or not. But we think that over a period of time, they'll probably ramp up OMOs further. Once you do that, that solves, so the liquidity easing in the system solves a lot of your liquidity, your deposit problems also. Secondly, on the asset side, which is on the lending side, which was your question, agreed that, in consumer loans, if you're already seeing a mini asset, cycle build up, and, unsecured lending is something which RBI has really been stressing on and has clamped down on, it's unlikely that banks will really go ahead and, lend in the unsecured consumer segment. But things like real estate, et cetera, could still see a boost. Because rate cuts will transmit through into home loans and other personal loans as well.